Welcome to my channel. I'm Scott, and in this video we're going to value UiPath by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. UiPath makes robotic process automation software. The company's software monitors user activity to automate repetitive front and back office tasks, including those performed using other business software, such as customer relationship management or enterprise resource planning. The company has been growing a lot each year. They currently have over 10,000 customers. The company was founded back in 2005 in Bucharest, Romania, but lots of their customers are in New York City, and that's where their current headquarters are. The ticker trades on the New York Stock Exchange, Deutsche Borse, Mexican Bolsa, and Sao Paulo Stock Exchange. Let's get started with the model. This is a mid-cap company, 9.5 billion market cap. They're trading at $17 a share, and they have 545 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative 380 million of free cash flow in 2020, a small positive in 2021, then back to negative in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative each year. Revenue is a sales for the company, and that grows a lot each year from 336 million to 600 million to nearly 900 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew from 277 million to 723 million. Below that is their operating expenses, and since their operating expenses are higher than their gross profit, they have negative operating income each year. They receive 3.6 million of interest on their investments. They don't really have any debt, so they don't pay interest on their debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example is the gain or loss on the sale of an asset. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income, which is negative each year. This is the company's income statement from their latest 10K. And here's a breakdown of their revenue. 480 million is from licenses. They receive revenue from licensing out their software. The next biggest bucket is subscriptions, 370 million. Then additional services is 41 million. And each category grows a good amount each year. Every section more than doubled since 2020. Then you have your expenses, only 12 million in licensing, 61 million in subscriptions, and 96 million in professional services. So you can see professional services, they actually lose money because they only generated 41 million of revenue and their expenses are 96 million. But this could be a loss leader. By doing additional work for a company, it may get that company to license their software or buy a subscription, which is where their margins are. So their gross profit is growing each year from 277 million to 723 million. They spent 700 million in marketing, 277 million in R&D, and 250 million in G&A. So they have an operating loss each year. And their loss per share was 341 in 2020, then a loss of 55 cents, then a loss of $1.16. They IPO'd in 2021. That's why their shares outstanding went from 168 million to 450 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. And they spent 13 million in CapEx in 2022. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And that's negative in 2020 and 2022, but a positive in 2021. They issued lots of stock in 2022 from IPOing. In 2021, it was 226 million. In 2020, it was 584 million. And they don't have any long-term debt on their balance sheet. They paid it all off in 2021. This is the operating section of their statement of cash flows, and the way you calculate operating cash flow, you start with your net income. In this case, it's a net loss of 526 million. Then you add or subtract the non-cash items on the income statement. The big number is stock-based compensation, which is $516 million, so we have to add that back, and then adjust for changes in working capital. So even though they reported a net loss of $525 million, they only lost $55 million of cash flow. This is the investing and financing sections on their statement of cash flows. This is for the accounting year 2022. In their investing section, they bought $213 million of marketable securities. These are highly liquid, short-term investments. So instead of sitting on cash, they can earn a little interest on that cash. They sold 89 million of those securities and 108 million matured. They bought 9 million of property, plant, and equipment. They spent 5.5 million in business acquisitions and some other small purchases. So they had a cash outflow of 35 million in their investing section. In their financing section, they received 700 million from selling common stock. They received 750 million from selling convertible preferred stock. So if the holders of this preferred stock convert to common stock, it will dilute the current shareholders. So in their financing section, they had a cash inflow of $1.5 billion. This is the equity section on their 131 balance sheet. They received $3.4 billion from selling their business, and they lost $1.5 billion from running their business. Let's look at their capital structure. $1.9 billion of equity, $51 million of debt. They're 97% equity, 3% debt. And you can see they have lots of cash in their balance sheet, $1.8 billion. And I gave them a WACC of 8%. That's the average WACC of Simply Wall Street and the lowest WACC on Finbox. And that's the discount rate we're going to apply to the future cash flows. We estimated 5 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 5, that's 11 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.2 billion. We divide that by 545 million shares. And we get a calculated stock price of $15. They're trading at $17.40, so they're trading at a 16% premium. It's a sell according to the model. The company projects their revenue to be $1.86 billion in 2025. And then in 2024, the projection is $1.4 billion. 2023 is $1.1 billion. And I continued this growth the next 2 years. So I got $2.3 billion in 2026 and $2.8 billion in 2027. That's how I got their future revenue estimates. The average company in their industry converts 21% of their revenue into free cash flow. So I multiplied these 2 years of revenue by 21%. That's how I got their free cash flows. And I assumed they would have negative free cash flow up through 2025. The website Simply Wall Street values the company at $24. They're saying it's 29% undervalued. 18 analysts priced this stock and the average price target is 35, the low is 23, the high is 58. The stock started trading almost exactly a year ago. But in the past year, the stock market has not done too well, including this stock. It's pretty much only gone downhill. It peaked at $80 at one point. Now it's sitting below $20. When you see red bars, that means sell orders are higher than buy orders, and the stock goes down. When you see green bars, that means buy orders are greater than sell orders, and the stock goes up. In the past 52 weeks, the stock is down 80%, while the S&P is down 7%. The 52-week low is 14, the high is 90, and the stock is trading well below its 50-day and 200-day moving average. 8 million shares are traded each day on this stock. 54% of the shares are held by institutions and 5.5% of the shares are shorted. If you put $10,000 into this company when they started trading, you'd be at $2,500 today. That's a 75% loss. In the past 12 months, there's been only sell orders, no buy orders. All the sell orders are above the current trading price, so I'm sure these people are happy. They can buy back in at a lower price if they wanted to. 47% of the shares are held by institutions, 26% by the general public, 21% by insiders, and 5% by venture capital and private equity firms. The co-founder and CEO of the company owns 20% of their stock. His valuation is almost $2 billion. But at one point, his valuation was close to $10 billion. Cathie Wood's ARK Investment owns 6% of the stock, then Capital G, Vanguard, and T. Rowe Price. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Price to sales of 10.6, that's stock price over sales per share. The market average is 9.4, the median is 2.8. price to book of 4.9, and we cannot look at their price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. 19.5 million are marketable securities, 2.7 million of contract assets, 100 million of deferred contract acquisition costs. Contract assets are unbilled accounts receivables, where the goods or services have been sent to the customer, but payment is contingent upon a future event. Deferred contract acquisition is when the company defers sales commissions that are related to the acquisition of customer contracts. 17 million of property and equipment. That 17 million consists of 22 million of computers and equipment, 9 million of leasehold improvements, 5 million of furniture and fixtures, and 2.5 million of other. That sums to 39 million. And when you take away 22 million of depreciation, it gives you 17 million. The value of the assets they lease are $49 million, 17 million of intangibles. The 17 million consists of 12 million of developed technology, 89,000 of trade names and trademarks, 3.5 million of customer relationships, and 1.2 million of other. This is the gross amount. This is the amortization amount, and this is the net amount that appears on the balance sheet. 54 million of goodwill. Goodwill is the premium you pay when you acquire another company. It was 28 million in the beginning of 2021. Then they acquired Cloud Elements. That added another 28 million. And that gets adjusted for foreign currency translation. So the book value on the balance sheet is 54 million. 25 million of other, and 10.6 million of deferred tax assets. Here's a breakdown of the 10.6 million. That includes 29 million of deferred tax assets minus 18.7 million of deferred tax liabilities. Most of the deferred tax assets are net loss carry forwards. So when a company had losses in the past, it gets carried forward into the future until they become profitable, and then they could realize some of those losses. 38 million of stock-based compensation, 15 million of R&D. Most of the deferred tax liability is 17 million of commissions. Let's look at their non-current liabilities. 4.5 million of other. They owe 50 million on our operating leases and 69 million of deferred revenue. They have 69 million of deferred revenue that is due beyond 12 months and 297 million of deferred revenue that is due within 12 months. So we'll see the 297 million on their current liability section. They have a high current ratio of 4.3, that's current assets over current liabilities. Same thing with the quick ratio since they have no inventory. Let's look at their current assets. 1.8 billion of cash and cash equivalents. That 1.8 billion consists of cash, bank deposits, and money market accounts. They have 116 million of marketable securities. That consists of corporate bonds, muni bonds, and commercial paper. They have 252 million of accounts receivables. This is how much money their customers owe them. 75 million of contract assets. In the beginning of the accounting period, they had 36 million of contract assets. Then they added 78 million. They received 34 million of payment from their customers. So the ending balance is 78 million. And 75 million is due within 12 months. 2.7 million is due beyond 12 months. So we saw this 2.7 million in their non-current asset section. They have 30 million of deferred contract acquisition costs. Here's a breakdown of the 30 million. The beginning balance was 43 million. They added 130 million. They amortized 39 million. And foreign exchange translation was 4 million. So the ending balance is 130 million. 30 million is due within 12 months, 100 million is due beyond 12 months. So 100 million appears in the non-current asset section. And they have 55 million of prepaid expenses. Here's a breakdown of their prepaid expenses. 29 million of prepaid expenses, 3.3 million of value-added taxes or receivables, 6.8 million of other receivables, and 16 million of supplier advances. Let's look at their current liabilities. 11.5 million of accounts payable, 88 million of accrued expenses. Here's a breakdown of the 88 million. 22 million of accrued expenses, 17 million of withholding taxes, 4.3 million in employee stock purchase plans, 7 million of payroll taxes, 18 million of income taxes, 9.3 million of value-added taxes, 1.6 million of operating leases, and 9.2 million of other. They have 131 million of accrued compensation. This is how much money they owe their employees, and 297 million of deferred revenue. In the fourth quarter of 2021, they had 7,900 customers. In the fourth quarter of 2022, it's over 10,000. And they have 1,500 customers that spend over $100,000 a year, and 158 customers that spend over $1 million a year. In 2022, they had negative 68 million of free cash flow, and they currently have 1.8 billion of working capital. So it looks like they have enough money to get through the next 12 months without raising any more capital. The best way to look at ratios to compare them to companies in the same industry. There are 146 companies in the same industry as UiPath. And if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They rank 26th in market cap at 9.5 billion. Average is 21 billion. They do have a better price to book ratio than the average. Their price to sales is a little worse than average. And we can't look at their PE or price to free cash flow since they have negative earnings and negative free cash flow. So to summarize, I have them trading at a 16% premium, but this company has some really innovative products. And it's not that easy to start a company and compete with them. It takes a lot of product knowledge to do what they do. And it's trading at a huge discount compared to its IPO price. So it could be a great time to get in. I rank their free cash flows 2 out of 10, their revenue 6 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.